Okay, so your budgeted income statement problem, I think, is pretty straightforward, dropping it into the format for the income statement. They tell you the cost of goods sold is a percentage of sales revenue. They give you the income tax rate. And I'm doing another example. You can kind of follow this, but I'm not going to just give you the answer. I'm going to make you do a little work. So we want to know, what is the sales volume to achieve after-tax income of $90,000? Okay. And so we did do target income in a previous chapter, but we didn't take into account the tax rate. So I'm going to show you a way you can just kind of work your way up to get our projected sales revenue that we would need to generate our after-tax income that we want. So the income taxes are 25% of our net income before taxes. So if we take the $90,000, because that must be 75% of our net income before income taxes, divide that by the 0.75, and that gets us our net income before taxes, right? And if we go the 120 times our tax rate, that's the 30. That's how we get to the 90,000, right? We're just kind of working our way up. Our selling and administrative expenses, let's assume those are fixed. Those aren't going to change. So that means our gross profit would be $302,100, right? Our gross profit minus our selling and administrative expenses gets us to our net income. So then we can back our way into our sales, right? Because our cost of goods sold is 60% of our sales revenue. That means our gross profit was 40%. So we're going to take the 302,100, divide that by 40%. That gets us 755,250, right? And then if we want to be working our way down, cost of goods sold is 60% of the sales revenue, right? The 75,250 minus the 453,150. That gets us to the 302,100. And so we know we have the right number. So the sales volume to achieve an after-tax income of $90,000 is going to be the $755,250.